Hello there, it's me, Stephen Thomas with Reports on Housing, and I'm coming to you with another housing debrief. Thank you for joining us, really appreciate it. We're gonna get right into it because it's been pretty exciting watching this last little over a week, and that's because rates have plunged. It's absolutely fantastic, great news for buyers, and finally they're getting that break. And this is all due to the Federal Reserve. We've been very Federal Reserve focused. If you are a lender, you're Federal Reserve focused. But even if you're an agent, a broker, you're looking at what the Federal Reserve is doing. You're even looking at what's going on in the economy and what the Federal Reserve has to say. If you're in the real estate entity, such as a buyer or a seller, a homeowner, looking to see what when they can actually pull the trigger and do something. Because the Federal Reserve has talked about cutting rates, but they've said they're very, very data dependent. Now, because they're so data dependent, we've been watching everything on a monthly basis. And the month of April was absolutely awful for rates. Then along came May. May was fantastic. It was the beginning. We had that rough patch that started in February. So February, March, and April was this 3-month period that, man, it looked like the economy was reheating. But there was a lot of data points behind the scenes that people weren't paying attention to, that economists were, and we were waving our hands going, dudes, you guys need to actually be cutting now. And we've been talking about that for quite some time here at Reports on Housing, that the Federal Reserve should have already been making cuts, in our opinion. They're waiting too long. So May was fantastic, and then along came June. June was absolutely fantastic. Then along came July. July was over the top, especially as the month progressed and we got all those inflation indices. They were showing that inflation was definitely coming down. And then came August. August is only 2 days old, and we already have had enough information to show that, man, maybe the Fed should have already made a move earlier this week when they met. And it is absolutely, for us nerds and for us following housing, we're going, holy cow, this is what people have been waiting for. We've talked about it before, and we said that the economy was going to cool either in the spring or the summer with a small chance that it would happen in the autumn. It didn't happen in the spring, but it's definitely happening in the summer, where things were hot, and it's definitely the housing, not just housing, the overall economy is decelerating. And we'll talk really quick about inflation, because inflation came on Friday. And there's something, everybody follows CPI, Consumer Price Index, and a lot of people hear about it, and they always say inflation's up. And then they talk about this index because this is the index that gets the most news. But that's actually Consumer Price Index. The index that actually came out on Friday is another index. It's called Personal Consumption Expenditures, PCE, Price Index. And this PCE is actually the Federal Reserve's preferred inflation index. And this is actually closer to their 2% target that they want to see. If you actually look at this, you can see I'm pointing to core, the purple line, and then the purple dots are each month on the arrow at the top. And you can see it's been coming down slowly but surely every single month. And it's illustrating that, inflation is not out of control. It's below 3. It's making its way towards 2. We'll eventually get there. And the Fed does not have to wait till it gets down to 2% to start cutting rates. They want to see that, the economy is doing its work. Things are slowing down. We better make a change because we're so restrictive early, so that the economy doesn't suffer from keeping things too tight with elevated rates. Now, the Fed is another aspect. So we talked about inflation. This all came out within the last week. So we had an inflation index that came out on Friday. The Fed actually met this week. They meet every 6 weeks, so it doesn't always jive with the different reports that I'm coming out with, but this has been a gigantic action-packed last week. The Federal Reserve met, and they met Monday, Tuesday, Wednesday. They had Jerome Powell, the head of the Federal Reserve, had a presser. And He's on the right-hand side of this photo, and they had a press conference. He has these notes that he goes by and that he reads, and then after that, it's Q&A. Now they're a lot more. They are a lot more transparent than they used to be in the past. So they answer a lot of questions, and sometimes he goes a bit off script, and he was all over the place, hemming and hawing, and he was illustrating what happened. Was he was saying that we're not cutting rates right now in July. We are going to. There's a high probability that's going to happen in September. Pretty much kind of talking about, you know what, we're not doing it now, setting up for it to happen in September. We were saying that they should have gone in June. Man, we were saying that they should have gone as at the start of the year towards March. And now we didn't go in June. We did not go in July. And now the next time they meet is not for another 45 days, which is September. And so that's what they're talking about, this September. But the fact that they were orchestrating that, yes, we're probably going to go in September, we saw rates starting to tumble. It tumbled at the end of last week with inflation news. It tumbled further this week with the Fed meeting. And then it tumbled even further when the odds of the September rate cut were, traders have it now at 100%, and pretty much everybody now believes it's going to be at least a 25% basis point cut. Could possibly be more. I don't actually think they're going to do that. Should they do more? Absolutely, but they don't want to interfere with an election that's so close to the election that they're going to be accused of political manipulation, which is not what they're about. They're actually behind right now. So that's so we've had inflation, we've had the Fed, and we've had jobs. This is actually the first week. It's just the second, but it's the Jobs Friday comes out on the first week. If it's the first of the month, they typically don't do Jobs Friday on the Friday, but this is the second of the month, Jobs Friday, when we're actually doing this housing debrief. And the jobs came out, and actually yesterday we had initial jobless claims, and it was at the highest level in almost a year when you go back. So it's been a long time. So it's U.S. initial jobless claims hit at a highest level in almost a year. Continuous claims rose to the highest level since November of 2021. So we're actually seeing that, and you see this curve, that initial jobless claims actually predisposes where unemployment, where the job market's going. And you can see that things are slowing. It's not as juiced as it was before. And that's what it's starting to paint, slowly but surely, marching its way from the lows of about 200 all the way up to it's about 250 now. Once it gets to 300, that's where you're going to see a few more cracks in the economy. And then along came today, and today is Jobs Friday. And with Jobs Friday, we had, earlier this week, we had job openings, but more importantly, Jobs Friday, this July report. This July report actually says that we're down we're down to 114,000 jobs created last month. And it was supposed to be like 165,000. Instead, it was 114,000. So you can see the curve. It's making its way down, definitely down, and it's getting less and less. So we're at 114,000, and unemployment ticked up from 4.1% to 4.3%. You could see that curve too. Slowly but surely, it was down at a level that was at its lowest level since 1969. So very, very low levels, and then slowly but surely, it's made its way up, and it's at 4.3% right now, which is. It's not where we have a giant unemployment problem. It's that the trajectory of this curve and where things are moving, it kind of illustrates that things are really slowing down. The job arena isn't as hot. Now, the Fed better ease back on their policy because they're being too restrictive, and they could cause a recession. And now that things are actually breaking a little bit in the economy, it's not just everything is all rosy and the economy is going to continue to be rock solid and rocket forward at 100 miles per hour. That's kind of where we were last year in 2023 as consumption was off the charts and people were still draining all of this stimulus money that they had saved in their savings accounts. And now they've dipped into their savings quite a bit. Those extra savings are absolutely gone. And there are other headwinds that we could talk about, but we're not going to get into the weeds. So when things break, there's a lot of cash sitting on the sidelines, and they look for a safe haven. And this safe haven, one of the things they want to do is get into the stocks when the stock market does a giant correction. And another thing is when there's a slowdown in the economy, they like to diversify their money and not have it in cash. Instead, hold it at these bonds that will continue. Right now, they're at high rates. They go down lower as the economy cools. So they want to get in early. So there's a flood of cash. And where do they go? They go to 10-year treasury and to 10-year treasuries and mortgage-backed securities. And when they flood that market, it means that when 10-year treasury, the yields start to go down, so they don't make as much when they start investing in 10-year treasuries because there's too much appetite for it. Just as with mortgage-backed securities, when there's a lot of appetite for mortgage-backed securities, we get interest rates that come down. So what happens are these traders that are sitting with lots of cash, these investors sitting with lots of cash are flooding 10-year treasuries and mortgage-backed securities so that they're both going down right now because of what's happening in the economy. And there's this love affair that happens between the two. So pretty much they are lock and step. When interest rates, when 10-year treasury goes down, interest rates go down. When 10-year treasury goes up, interest rates go up. And the average spread going back to 1972 is 1.71. Above wherever the 10-year treasury is. So, but right now that spread is larger than normal, but we won't get into that either. That's just more nuance. That means that rates will come down even further when things start normalizing and the Fed isn't being as aggressive. So rates have dropped in response to the investors flooding the market and flooding mortgage-backed securities and 10-year treasuries with all of the recent negative economic news, which means that it cooperates with rates. Rates come down. And rates right now, you can see this is actually 10-year treasury. 10-year treasuries were a lot higher. And you can actually see that Himalaya on the left-hand side. That Himalaya was back in October when we hit, when the 10-year treasury hit 5%. We actually had interest rates at 8% at the time. And here we are. You could see that big, gigantic drop that I was talking about just within the last week. We've been at 4.25 and made our way all the way down to 3.8 just about. That is a gigantic drop. Now, similarly, you could see, if you look at that, you could see the Himalayas. This is a very similar pattern, and this is because this is actually mortgage rates. And where we are today is at 6.4%. So we had a big drop on Wednesday. We had another drop yesterday, and we had a gigantic drop today, and we're at 6.4%. Now, I need to enlighten you as to how long ago we had interest rates this low. And so I have to broaden this out because this one, it's the lowest in the last year. So it even goes past that. It is the lowest interest rate that we've had. You have to go all the way back to April 13th of last year, 2023, to see rates that were at where we are today. And it was actually very, very similar. It was at 6.39 on April 13th. And so you have to go, if rates even drop even further, you could see that we'll make our way back to like February 1st. So that's where rates have gone in such a short period of time. We've had a gigantic drop within the last week of more than 0.5%. That's just in 1 week, 0.5% drop in rates, which is very, very favorable because keep in mind, back in April, we hit 7.5%. And this is according to Mortgage News Daily. This is with no points. 7.5% interest rates 3 times in April. And we are already a whole percentage point less than that in such a short period of time since April. So shoot, we're less than 4 months out from when we were last at 7.5%. So this is a big change in such a short period of time. Rule of thumb for refinancing is when you come down a full percent, it makes sense to refinance. So there's already people that may have closed recently, just they locked in April, closed, already have rates that are more favorable. Shoot, makes sense for them to refinance already. So let's see. So it is super exciting to be a buyer right now. And why? Because it really increases buyers' purchasing power. It is a significant change. The change is so large that it is $100,000 extra home that you can buy from the difference from 7.5% to 6.4%. That's $100,000 more of a home that you can purchase if you're looking if you were looking at a $5,000 per month payment with 20% down and just principal and interest. That is a significant change in how much you're able to afford. And I just threw out $1 million because here I am in SoCal, but you do the math in any market, and it's a significant difference when interest rates fall a full percentage point, which is what they've done, which is increasing the buyer power. Now I'm going to get completely nerdy on you, and I'm going to get close and talk to you about what that means to the market. So here's what's going on right now. The market has not absorbed these low rates yet. We kind of have to have them with duration, but we've had lower rates that have been occurring for the last few weeks. It just it plunged within the last week. And now they're extremely favorable from where they were just a few short months ago. And so now that we're here, we've actually had the inventory has been increasing behind the scenes, and demand has come down. And when you have increasing inventory and demand's coming down, which recently within the last week, demand's flat, but inventory is still going up. So what that's a recipe for when you have inventory going up, demand going down, is the market is slowing. So the market has really slowed to the point where it's more balanced. It's not quite a hot seller's market anymore, and it's not quite a buyer's market. It's more balanced. It's in between. So there are properties that are languishing on the market for longer. Buyers don't have to pull the trigger in 1 second unless, of course, it's priced right now, has all the bells and whistles, and there's a lot of activity. There's still a lot of that exists, but there are a lot of homes that are just sitting out there. So you can actually take your time a bit right now. Now, as rates continue to go down lower with more economic reports that are coming out down the road, you can imagine that will just invite even more buyers to the marketplace. And now that rates are coming down, it's going to invite more demand, and we're going to watch actually more pending sales activity as these buyers enter the marketplace because things are becoming a lot more favorable for buyers. And there will be more homes that come on the market because there are a lot of people that are locked in with these low rates, but rates coming down will start to invite more homeowners to place their homes on the market. But the increase in demand out there is going to outpace the number of homes coming on the market. So we're actually going to see inventory start to come down. We're already seeing a lot of markets where the inventories have peaked out. So from here, inventories will come down. With more demand coming up, inventories will come down even further. And that's a recipe for, if you have demand actually staying flat or going up and you have inventories coming down, the market's getting hotter. So when's a good time to get in if you're a buyer and you're ready to go and you're ready to pull the trigger? Shoot, these rates are a really good opportunity. The speed of the market has slowed down. That makes it a good opportunity. So when is that? It's actually right now. I've said it before. It was now back in February. It's now right now. This is actually a really good time. It's a lot more of a buyer-friendly market. So this is a time to get in. So if you want more information, go to reportsonhousing.com. And you know what? The most recent one that came out is actually called a buyer-friendly shift. So if you were to subscribe to any of our reports that dot all over SoCal, including Ventura and San Diego, Orange County, LA, Riverside, San Bernardino, the Bay Area, we have Clark County in Vegas, and we have Maricopa, Phoenix, and these are all the different counties that we have reports for. So go to reportsonhousing.com. You'll get the most recent one. Use the coupon code PLUNGE, and you will get this latest one. And then there will be a new report along the coast here that comes out, the southern coast, that comes out this coming up week. And then all the other markets will get it the following week. That's what we're working on right now behind the scenes. So thank you so much for joining us. Appreciate it. I hope you have a fantastic finish to your week. Great weekend, and we will see you on the other side.